Okay, good afternoon, everyone. If you are joining us here, we're going to be live in less than 1 minute. We've got a lot of action for you folks today. And okay, so hey, welcome everyone. This is Demetrius with Akeelah Traders. I'm going to welcome you to our live weekly market review. So if you're here today, I'm grateful for you. I thank God for you for joining us on our channel today. And so here at Akeelah Traders, we have a very unique trading system. We have a very unique way of looking at the markets. We approach markets from a very structured method. We have a system that we operate on called the Akeelah Market Makers strategy, and it's based on looking at higher time frames and establishing a clear market direction. We have some very strategic ways and proprietary ways that we identify demand zones and supply zones. They're very non-traditional, so this is not going to be a traditional approach to what you may typically see in the market, and those are the kinds of things that we focus on here at Akeelah Traders. So we're going to dive into this today. In today's market review, we're going to take a look at a couple of top assets that we've been tracking for a while. So I want to encourage you, if you haven't been following us here on our channel, please follow us, give us a like, subscribe here to the channel. Also join us on TradingView. I'm going to give you a sneak peek, just a snapshot view of some of the things that we're doing over on TradingView. And so that's typically where I'm posting most of the analyses that we have going on. We're looking at TradingView charts, and so you can see things on here like the different ideas that we posted, and some of them are mine, just little short snapshot thoughts of the market. But our ideas usually give you a very strategic way of how we look at the market structure, how we identify high probability buying and selling zones, high probability opportunities to get into the market. So I encourage you to look through there. We've got posts on everything from the NASDAQ, NVIDIA, S&P, cryptos like Bitcoin. We've looked at individual stocks like Eli Lilly. Gold is one of our favorites. Oil. People are kind of excited about what's going on with oil right now, with things like the war and tariffs, and are we reaching a peace deal with Iran and the U.S.? It's not. All those different kinds of things. Go in and take a look at some of our strategic analyses on oil, and you can see how the market has been playing a pattern out that's well in advance of the news and the headlines. And you're going to be able to look at things like that to get an idea of what's going on with something like oil. So let's dive in today, go into the NASDAQ. And so I'm going to start on the daily chart, and we're going to take a look at what the NASDAQ has been doing and what we expect it to continue to do based on the structure that we have seen. So I'm going to go back here, and I'm going to talk about one or two critical areas. So back here this is the week. So I'm on the daily chart right now. So this is on the day of June 2nd. Just say between June 2nd and June 3rd is when the NASDAQ hit its all-time high. And this was up here. Everything peaked out right around 30,756 or so. And so that was an all-time high. So great. People are, I like to say, clicking champagne glasses and eating caviar, celebrating how great the market was doing. But what was brewing after that was that you'll see what we had identified as our demand zone. And our demand zone, the way we define them here at Akeelah, is a demand zone is an area or range of prices where the market makers, or the overall market, the people who are controlling the hundreds of billions of dollars in the market. So a demand zone is an area or range of prices where the market makers have already told us that there's a high probability to buy an asset. Excuse me. So they've already told us that it's a high probability to buy this asset there. So when we look at things like that, we are able to see that, this demand zone, the market is telling us that we want to buy down here. And at the time, that demand zone was somewhere between 28,580 and 29,000. So at the time, I'm going to go back in time a little bit. In time, the market was up here sitting over 30,000, near 30,800. So we're able to strategically look at the market like that and say, hey, don't jump in and start trying to buy the NASDAQ right here, because it needs to have a pullback back down to this area. That's a normal, healthy pullback for the market. It doesn't mean that there's a crisis going on. It doesn't mean there's anything dramatic that's happening in the overall market. It just means that there's an imbalance, and the structure is saying big money, smart money, money makers, market makers, whatever you want to call them, they're saying, hey, our demand to buy this asset is down here. So what we're looking for is to see if and when we get a sign that the market's going to pull back to here. So what we identified after that, you'll see shortly thereafter, the market did come down here. So we're not always able to call this particular play, other than there's some things that we look at to see how overextended the market is. In this case, we were calling for the NASDAQ to fall back this far because if you look between this low period right here, May 19th, all the way up through June 2nd, there's nothing but actually significantly large daily candles. You see all of these several candles here that just kept pushing. Markets do not operate like that. Anytime something like that happens, you see just a substantial push in one direction, it's almost always going to be a pullback, folks. You just need to be patient and wait for that full pullback. Where it's going to pull back to, you need to be able to identify these demand zones as we identify them. And again, we have a proprietary way that we're able to look at. And that's not a traditional way of finding demand zones, but we find them, and with very high probability, the markets come back to there. So this is what we saw. Now, once we see that, so this is an area that if the NASDAQ were to remain healthy and continue bullish, it could have pulled back as low as this range, as low as 28.6 or so, and still been healthy. But, and if we get a close on the NASDAQ below this demand zone, this area here, which we did on June 10th, that says that's an issue. That's the market's first signal, the first sign that something is going on, that this structure that we've seen where the market was bullish and continued bullish all the way, I'd have to go back several days back here. If you come all the way back here to March timeframe. So from March all the way through June, the NASDAQ did nothing but pump up. When we see a structural break like this, which we define a break of structure, we'll abbreviate it a BOS. And our definition of break of structure is when we get a market to produce a candle that closes below the last daily demand zone. And I've already defined what that demand zone is. That is a high probability area or range where the market makers have already told us that there's a demand to buy the asset. So if we see that get broken, not with just a wick, so a wick like this, market flashes down below here and closes back up, that means nothing in the Akeelah system and our way of looking at the market. But when you get a close like this, that triggers what we call a break of structure. And so we would identify that and say, hey, we see a daily break of structure here. Now, what do I typically expect to see after a daily break of structure? Well, with a daily break of structure or any structural range, because this is, we can play this on different time frames. In our system, our strategic way of looking at these markets, there's an extremely high probability that once the market breaks that structure, there's going to be a pullback. There's going to be a fake out. Where is that fake out? So we see this break here is down. The market came down and broke below what should have been a demand, a price holding structure. So that's a strong downward move. The market is very rarely going to continue down. This is another trick that's built into the market system. We see this kind of break almost immediately, or definitely in the near future, we expect to see a pullback, a fake out, back up. So why is the market going to push back up? I say it's a fake out, and this time is to trap people on both ends. These people that see this, and if you're following regular supply and demand zone logic, you're following smart money concepts, you're following ICT trading strategies, you can potentially be tricked by this thinking, hey, this broke this level. I'm looking for this to retest right in here and continue falling. That's not going to happen, folks. It's not going to happen. And we've seen it play out over and over and over. So we expect to see the market try to trap these over aggressive sellers who thinks that now this market is going to sell. So they enter sell positions. The market is going to push back up, take those people out. And now is going to trap again the buyers who are saying, oh, you know, this break below this level, that wasn't anything significant. The market's returning and we're going to all-time high, babies. And we're saying, no, we're not. This is the signal to say we are going down, but before we go down, this is, say, the market maker speaking, we're going down, but before we go down, we're going to take as many people money as possible. We're going to take these sellers' money, we're going to push back up, and we're going to trap people into buying again, thinking the NASDAQ is going to an all-time high. But where they're going to this area up here that we identify as a source zone. So again, we have a strategic way of finding, well, how do you identify the source? Well, that takes a little more detailed training, a little more specific way to read these candle formations to see where you find that zone. But the case in point here is that once we see this break, we almost always see a pull back up to this yellow area. And from there, that's where your true trade is. That's where the true trade becomes. And this is why we have this entry here. We entered a sell on the NASDAQ back here, not down here when it broke this structure. We're not necessarily trying to sell it up here this first time when it's at all-time high, because we don't know what it's going to do. It could continue going up. Now, until it pulled back, we would have had a buy down here saying, I expect you to pull to this area and buy. But once you break this structure, I'm looking for you to pull back here, and I'm going to sell this baby. And when we sell it this time, this is what we call a confirmed sell, a confirmation. Now, this market has confirmed that it's going to sell. Where is it going once it sells? Well, we identify another, what we call either a source or high probability areas. Those high probability areas would either be a source, in this case, a demand source. So where is the true structural area where the market makers have accumulated a significant amount or a substantial amount of buying volume? It's not going to be this daily demand zone area anymore. The market is not going to just pull back to here and go back up again. It already broke this. And as I mentioned earlier, if it had just pulled back and wicked below it, that's fine. But once you get a close, this is like having a crack in the floor or in the ceiling. You have a 2 or 3 story house, and you get a floor that a substantial joist breaks and the floor is cracked. Well, that floor is compromised now. You're not going to take your baby grand piano and set it up on that 3rd floor anymore over that spot, because it's already been cracked. It's more likely to fall. So the market is going to push through here. We just need to see where it's going to go. So in that case, we have a strategic way of identifying either fair value gaps. If you don't know what fair value gaps is, you can look that up or join us on one of our classes. We can go into more details of that. But in short, a fair value gap is just an opportunity of where the market pushed too quickly, or too strongly, too quickly. And it left an area where there was not an opportunity for sellers to balance the books. There was too much buying, not enough selling. So the selling volume skipped actual prices, where there were people saying, well, hey, I was willing to sell down here, but because you skipped all the way up here, now I have to sell at this high range, but it leaves an imbalance. So when we see a break of structure like that, our target is going to be either a fair value gap area, which we already have one identified here. This is this 26, the top of this is 26,920. So this is where the NASDAQ is going, folks. And again, I'm speaking very authoritatively. I'm speaking very confidently, because this is my system. This is my system. This is how I trade. This is how we created a way to read the markets. We may be wrong. There are times when we're wrong. And if we're wrong, I just say, oh, well, we was wrong that time. But, we're seeing strategically, if we follow this, 75%, 80% plus sometimes, that we're seeing the market play out exactly like it is. And we have some ways to cover a couple of nuances in case it doesn't happen. But this is the target for the NASDAQ. The next target would be what would be identified as a source, and that's an area further down here. That's down around 24,580. So down at this area here is where, if this fair value gap here doesn't hold, we're always in a position with our Akeelah traders, and our mindset is we want to read what the market is telling me. Tell me what you're producing. Tell me what you're trying to create. If and when you get to that area, I'm going to see if this fair value gap area holds. There's things that I'm looking for to tell me whether the market is satisfied here. If I see that, then the market is going to go back up. If I don't see that, or don't see that buy confirmation, then it's going to fall down to here. So I'm not ready to say it's going all the way down to 24,580 yet. I am saying, as we did back here, that these are the target areas. If that daily demand zone did not hold, the target is the daily fair value gap, which is here, and eventually the daily demand source. But I'm just making the point that that's contingent on this not holding. So that's where we're looking at for the NASDAQ, folks. If you see these last couple of days, we've had just red candles. That's to be expected. I'm in a lot of these different trading channels, and people are asking, hey, why is it falling? I thought it was going to bounce here and go back up. And I'm saying, folks, the structure has already been broken. We're coming at least to 26,920. Okay. All right. So that's it for the NASDAQ. If there's anyone that is joining us here online, if you're in the chat, I would love to respond to you in the chat. If you have any questions or comments, let me just look briefly to see if anyone is in there. If not, I'm going to say welcome to our market review. And then please do leave any questions. Okay. All right. And so next, we're going to dive into the next asset. Let me go there. And I apologize that this is live, but I am going to have to pause for just 1 second. So forgive me, folks. Hey, love. Hello. Hey, love. Hey, what's up, babe? Huh? What's going on? That's in the same building? Or okay. 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 All right. Okay. 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 All right. Well, do that. I'm in this. Okay. Well, text me what the room number is now. And then, okay. Okay, love. All right. Thanks, babes. Thanks. Okay. Love you. Okay, folks, I do greatly apologize. I had something very, very significant and important I needed to pull up there. So please forgive me. That happens with live broadcast sometime. Okay, so let's jump to our next one. That was a look at the NASDAQ. I'm going to jump over to gold this time. And so we're going to take a look at the same thing. I'm going to stay on a little bit higher time frame and walk back a little bit and show just what our plan has been on gold, what we've been looking at, and where we're looking for gold to go. Gold has been making some pretty significant moves. I'm just going to start forward here on this one, and I'll walk backwards. So right now for gold, I'm looking on the daily time frame, and what you'll see is that we are sitting up inside of right near what I'm calling a H4 main source on here. And so this is an area of extremely high demand, or a high probability that there will be demand and buying in this area. So why is this area here so critical? Because I'm going to walk back to show you the same process. If you were following through our logic on the NASDAQ, you're going to see what happened back here on gold is, I'm going to go to the 4-hour time frame for these purposes. And I'm going to go look back here. When we had an all-time high back here on gold, gold made an all-time high on around, that is January, maybe near the end of January, the first part of February. Okay. So when that happened, we had an all-time high in this area. So at that time, we had a structural area on the 4-hour. So I'm looking between the 4-hour and the daily. So here on the 4-hour, we had a structural area at the time where there was a demand zone right in this area. Okay. And so we've since updated that because we pushed through this, but I'm making the point to tell you how we got to identifying this source. So this was an area that said, hey, gold had a structural break, same kind of process that we saw before. Broke this structure right in here. So this would have been a break of structure. We expect to see the market not to just continue falling, which it fell pretty good, folks. It fell all the way down to 4,400. We did some posts back at the time on our trading view channel, and I believe in one of our Telegram channels, about how and why gold was potentially coming back down to this 4,400 area. But nonetheless, this structural break up here, think about the same process I just spoke about on NASDAQ. We saw a break of structure down. Instead of the market continuing to fall down to this area, which this would have been the source of that, what we saw was a breakdown and a pullback back up. But this is the point. This yellow box identifies where that source area is. So the fake out that we were expecting was to see this to push back up, but not high enough to break above this area. This is the fake area. Push gold back up into here to entice buyers who think that, hey, we recovered from these lows. Gold is finally going to push up, and we're going to break back up above this area. That's not going to happen. This confirmation was already done. So same trick, different asset, same mindset, same strategic way of looking at this. We're seeing a breakdown. Don't fall for the sell. Don't be one of the sellers who trapped it. And most people would have an area like this identified. I'm going to put a box on here because some of these other traditional demand zones, smart money concepts, those kinds of things would have had an area somewhere right in here, somewhere like this, that they would have had identified. And this is not our area, not exactly, but somewhere in here that says, hey, if you see gold break below here, then you sell it. And so maybe they would have started selling here and wrote it down. But if you see what happened, gold did push down and even came back and retested this area and looked like it pushed back down. So others would have said, wait for this confirmation and then sell. But we're saying that's not it. The source is back up in this area. So I'm going to undo that because I don't want that on my chart. We're looking for gold to push back up into this yellow area. When it pushes back up into here, this is our sell opportunity. Sell gold back around this 5,300 to almost 5,400 area. That's the target to sell it. Now, source area, where is this ultimately going? Same thing as we've seen before. The source of this, because we're looking on the 4-hour time frame, we identify the source as an area to say, where did all of this buying activity? Gold has been buying back here. The first or the last major leg that we saw started back here in October of 2025. Gold pushed up, came up into this area. So we're seeing if we see this structure fails, we expect it to fall all the way back down to here. Now that's a hard swallow, folks, to be telling someone in March of 2026 when gold is sitting around $5,400 that, hey guys, gold is coming back to $4,000, $3,970. That's a hard pill to swallow. But strategically and according to the way our market maker strategy is and how we teach our traders and our investors, how we teach you to make smart decisions, this is where you want to get in. So whether you're doing options, whether you're trading CFDs, or whether you're just a long-term holder of these assets, stocks or commodities, these are the areas where you want to take these high probability trades and say, hey, I'm shorting gold at $5,400, $5,300 range, and I'm going to hold this trade. There's going to be some bounces. Gold bounced all the way down to 5,000, push back up to 5,200. You got to be able to ride those waves, knowing that you're following a higher market structure and you're following a higher probability proven system that is a strategic way of looking at the market. And this is a good time for me to point out, if you're noticing here, there are no indicators on my charts. We don't trade with indicators. We don't need indicators. We're learning how to read this market structure. And I'm not looking at moving averages. I'm not looking at exponential moving averages. I'm not looking at Bollinger Bands. I'm not looking at all of these kinds of, RSI indicator. I'm not looking at all of these tons of indicators that can cloud your charts and lead to confusion. We're looking at a clear way to say, if you consistently follow the pattern that markets play, learn to read these patterns, you can find these high probability trades. So let's see how this position, how did we get down to this area? Gold broke structure here, push back up. This was the ideal sell area. And now we see this fall. It came extremely close back here in March. And most people would have, and maybe even rightly so, you say, hey, on this fall, somewhere down in here, we're getting very close to this target. You're scaling out or taking a substantial amount of your profits in this area. Nothing wrong with that. I don't argue with anybody doing that. But I want you to see that even though gold made this push down, and some folks would see this pattern forming back up, and I've seen folks say, oh, hey, I see this V-shaped recovery. This V-shaped recovery is going to push back up. And it may well do that. Markets have done that in times. But strategically, what we're looking here is that, excuse me, this source area has not been satisfied. The market broke structure up here. It needs to come back to the source. We teach this in our trading academies as it's almost like a military commander, a military general giving a signal saying to his troops, hey, boys, we're marching north, and well, let me use the exact direction here. Let's say up in here, he's saying we're marching south, and we're marching south until we get to this particular destination. Well, these guys get part of the way there. They run into some kind of resistance, and they run into, some kind of challenge. And then you have a lower ranking military officer decide on his own that, hey, this is not working out. I know what the general said. I know the general told us to march until we get here, but I think it's better for us to just pull back and go back this way. That's not going to happen. You may see some retracements. You may see a little bit of pullback, but the market is not going to come back up here and recover these areas because the general gave the order to come here. So until the general reverses that order stays in place. And again, that's just my analogy for this. So how does the general replace an order? It has to be another structural move to push the market back up there. So we look for a similar break of structure or something that we saw the first time that led down to that's going to push us here. So gold came down here, tried to fake and push back up. Let's see how high did it actually get. Okay, it got fairly high. I mean, I'd say that's a significant pullback from 4,100 back up to 4,800 or so. But nonetheless, the target was to ride it down to here. And if you'll see, this is where we stand current day, current market time right now. Gold is sitting down in this 3,800, 3,900 area. It pushed down in here a couple of times. And so this is our demand. This is where we're looking to buy. This is where you want to make your entries, your buy entries on gold. However, it's still not a guaranteed buy. This is the highest probability area to start buying gold here, but we still want to see this area hold. So what we're doing now is saying that, hey, gold is in a buy zone as long as this main source is holding, the low of which is 38.85. As long as this is holding, we expect to see, like this blue arrow, I'm looking at this kind of a pattern. I'm expecting to see gold push down into this area, because until we get significant enough penetration in this area, the orders are not satisfied. So even these few wicks that we came down, notice how we wick down in here, but close back above, wick down, close back above, wick down, close back above. We really, for a healthy bounce and return back up on gold, we really need to see some candle bodies come down into this, what I'm calling main source area, demand source area. I want to see some healthy 4-hour candle bodies, preferably daily candle bodies, come down into this area and then show me bullish rejection off of the floor or the mid-range of this zone. That's what I'm looking for. So that's the pattern we're expecting to play out on gold. If and when that happens, the target now is going to be back up to these areas. The first area that needs to be retested is this previous daily demand zone, which was broken. I showed it to you on the 4-hour, but it was broken on the daily. That zone was broken. It became resistance. On the way back up is going to provide some resistance. So if we clear this area down in here, break back above, we'll come down preferably into the 38 to 3,900 with some candle bodies. Close back up above here, show that we are holding this area as support. Gold should propel itself all the way back up to this 4,500 area. Now between 45 and 4,600, I expect to see some resistance, maybe a little bit of consolidation. But if that area there then holds, then the target for gold will once again be back up here to this supply source back in the 51 to 5400 area, and that's a pretty wide range area. So when is it going to get there? I'm not in the business of projecting the time. We're in the business of projecting the strategy and the pathway to get there. Okay, so that is our second asset to look at is gold. The third one I want to take a look at today is going to be NVIDIA. So let's go to NVIDIA. And again, I appreciate you folks being here with us. For those who are joining us, or maybe you're watching this at a later time. So for NVIDIA, I'm going to go back to some posts that we did on NVIDIA a little while back to show how we kind of got to where we are. We've done a few posts here. I'm going to go back to this one back in May because this is the one that was the more recent one that kind of led us to the current pattern that we're seeing on NVIDIA. So let's jump in here and see what our post looked like in May. And so this is on May 21st. We did this post on TradingView. You can go to our TradingView channel, Akeelah Traders. On TradingView, you can go there. Please follow us. We try to regularly update these kind of assets that we're looking at. And so we're going to take a look at this stock, NVIDIA, and see what did we see at that time. So similar kind of thing. This post was done on the daily time frame, but we had identified a 4-hour demand zone. So typically, we recommend staying on the 4-hour and above. You can go down to the lower time frames, but for me, that just creates a lot of noise. That's a lot of confusion. There's going to be a lot of market movement back and forth. It's really going to be unnecessary. So if you're staying 4-hour and above, you should be able to see these kinds of structures more clearly. So here we had a 4-hour demand zone. And this 4-hour demand zone, we were saying at the time, this was on May 21st, gold had pushed up, almost looked like that NASDAQ chart, right? This looks very similar to what we saw then, just continuous candles up, 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 up. You know, so NVIDIA just pushed up, 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 up. These huge daily candles, as I mentioned before, nothing just continues going like that. So what happened is we're looking for, well, where is the demand zone? The last 4-hour demand zone was right in this area. Again, how we identify that, we cover that in a little more detail. It's some strategic ways that we look at things to identify this, but we said this was a demand zone area. So if gold were, I keep saying gold, forgive me, if NVIDIA was going to stay bullish, then it needed to hold above. We could not get a 4-hour candle to close below 219. If we get a 4-hour candle close below 219, then we're going to see a fall back down. And so we noted at that time, this demand zone must hold, or you're going to see a fall down to this daily demand zone. That daily demand zone at that time, it was around 200 to 195. You're going to see it fall at least to this area. So let's fast forward to see how gold did play out. And we would expect to see a typical, if we do a break, see a typical push back up to fake and then fall back down. That's the most likely pattern. The second option that I didn't cover previously is if there's going to be a stronger play in that direction, sometimes the market will fall below and just come back and retest this broken demand zone area and not even give you a close above it, which means it's going to be even a more aggressive sell. And so a more aggressive sell would be pulled back to here and keep falling. But typically we'd expect to see it pull back up into this area. So let's see, fast forward on NVIDIA to see how it happened. And let me go back. Okay, and so we saw the typical pattern. This is what I mean. And I hope you folks are seeing this. This is a recurring theme that we see played out. It broke the structure here, but instead of continuing to fall, you see this pull back up into this area. This was the sell on NVIDIA. And so we, at this time in May, we did this posting. Hey, NVIDIA had just posted great earnings back here on May 20th. So why is it falling? One of the hottest stocks on the planet just had great earnings. All of the pundits are saying, hey, NVIDIA is poised to go to $300, $350 and more. Why is it falling? Because this was a structural break. And there's nothing wrong with falling. As I've shown you before in previous videos and other times, markets need to pull back, but you don't need to break structure. So a market that is increasing should continue to increase and make new highs and new demand zones, but you need to hold those zones. If you get a break of structure, that's trouble. That's a signal that trouble is brewing. And so that's that first post that we did on NVIDIA, and that's what led us down to these current areas here. So right now, we've fallen all the way back down to this 190, and we had the target of going to 195 to 200. It actually fell below that. I think what's important to watch on NVIDIA, and this is what we're currently watching now. Let me just go to the live chart. What we're currently watching on NVIDIA right now is, so this fall, this was the daily demand zone. Now, we did have another area identified below this, that if the market broke this zone, where was it targeting? There's another fair value gap area that's clearly seen once you understand how to identify fair value gaps. And that was between 190 and 191. Notice how this came almost perfectly and filled that gap. So since that, this yellow area is our support area to test and to see if NVIDIA, if this chip is going to hold above this area. So as of right now, it's holding. So as of right now, this is the current floor. The market could potentially come back down and retest this 190, 191 area. As long as it holds, that's great. It can continue bullish, and the bullish case for NVIDIA will continue. And the projection is for it to, at minimum, push back up, back to test these this supply source area that was the original source of this fall that started. So what we're looking for right now is, I'm going to go, and I'm on the H4 now. What we're looking for right now, we've already seen the 4-hour break of structure back up. And so now that we've fallen down to this area, the 4-hour at least has said, hey, I've demonstrated enough of a push back up to say that this fall is probably over. Now, the 4-hour is our starting point for the lower time frames that you want to deal with. It's not my strongest confirmation. A stronger confirmation would be I want to see the same thing on the daily. So let's go to the daily. So daily, and let's look and see here. Daily, since we've had this push down, I want you to look at where I have identified as my daily supply zone. My daily supply zone right now is this area right in here, this red box. And so I don't have the price listed on there, but it is between like 206 and 213. So while the 4-hour has said, hey, I've made enough structural break to say I'm probably going to start going up, I want to see that on the daily. And I want you to see how significant this area is on here. So having already identified this daily demand zone, notice how we push up to this area. Right here came to it like almost exactly to the dollar, but failed to close above it. No close, no confirmation. It pushed up and got rejected. It pushed up again and got rejected. Pushed up again back here, almost came, this time didn't quite come up there. And you see a huge rejection back down after that. And this is where we're currently sitting today. The market came close to back down to this fair value gap area. And now we see a bullish response. So right now we're holding in this pattern between 190 and 206 is the area that the market could frankly just continue to consolidate in here for quite a while. But that's our look on NVIDIA. The key that we would need to see, what I would expect to see for a stronger confirmation that is NVIDIA ready to start buying again long term, I want to see a daily close back above 214, 214.14, 214.20, something like that. So daily close back above here. If we get that daily close, just like we've seen in all the other previous examples, I don't expect it to automatically keep going. I expect it to follow the pattern. Close above this, then give me a substantial pullback to fake out and take out all of the overzealous buyers who bought too early, wait for the confirmation down here, and then buy NVIDIA. Buy it. So our strongest buy area for NVIDIA was down here below 200 to this 190 area. I think like maybe 202 to 190 or something. That's our strong accumulation area. We'll continue to accumulate NVIDIA in this area as long as this floor here holds, this fair value gap holds. If this one breaks, let's look at the worst case or bearish case scenario. Other unsatisfied areas below this, I'm on the daily, so that's sufficient. Below this, if this area holds, there's another one down at 180 to 182. And this source, this is another 4-hour break of structure demand source. I still have this, that NVIDIA could possibly return to this area. I'm not saying it's going to do it. I'm not ready to say that it's looking like it's going to do it. But I'm saying the contingencies for that hold 190. If not, 180 must hold. If not, 174 is the target for NVIDIA. And this will be long-term. We're entering into an area down here that I would call kind of like a panic market flush area. So if we get down into this area, it's definitely a stronger long-term accumulation area. Nonetheless, if we come below this, it would be something broader going overall, either in the overall tech market is down or the overall U.S. economy market or the world stock market. Something substantial would have to go on to make us fall below this 169 area. Okay. So I think that's probably all we're going to have time for. Well, let's look briefly at the S&P 500 because that's the fourth one that I wanted to cover for today. And so let's bounce in and see what's going on. And the S&P 500, this one is very interesting because this is one of these that is currently being played out, not as well as the NASDAQ, but it's currently being played out with the same kind of structure. And so if you've watched the video up to this point, you should be able to see a clear strategy that we're following here. The S&P 500 has been making highs, just pumping ever since this time back here around the end of March. So high, all the way up to this area. This was our last demand zone. Daily, I'm on the daily chart right now. Our last daily demand zone was sitting up here around 75.05 was the bottom of that. We saw a close down below it. What do I expect to see with a close below a daily demand zone? That's a break of structure. I see that break of structure. I expect to see a pullback up to this yellow area. When I see a pullback up to that yellow area, I'm looking to see, is the market going to give me a new high? You need to produce a new high to calculate or reorganize the structure. If that doesn't happen and it pushes up here and we get a rejection, this baby is poised to fall. So where is it going to fall? So let's first see, did we get that rejection? Yes, it pushed up to here, came right into our yellow area and rejected. Did it come up again? It came up again a couple of times. We pushed up here. So this is where I saw this kind of structure and I'm saying, hey, folks, something's going on. I'm seeing this same pattern. I've as people have said before, I've seen this before. You know, I've watched this film play out numerous times. This daily break of structure down and it returned to the source and got rejected. The target is the daily fair value gap or a weekly demand zone. Where's our daily fair value gap for S&P? It's down here at 69.50. That's a pretty substantial fall on the S&P 500. 69.50 is the target. Our weekly demand zone is down here around 6,700. So what is the path to get there? We're already seeing it. As long as this daily demand zone here continues to get rejected, because it's already been broken the first time, market pullback, rejected the source. So this is the last line of defense, this 75.05. So I'm going to go to, before we end, I'm going to show you, just go and encourage you to take a look at the details of this post here on S&P. And I think I gave it a pretty funny title. Yeah. So S&P 500, this is the one we posted on July 15th. At that time, the price was $75.82. And we're saying, hey, remember that old OJ song, Backstabbers? They smiling in your face all the while trying to take your place. Backstabber. This is a backstabber move that's playing out on the S&P 500. So I expect to see this pattern play out, folks. We pushed up here. If this, and now we're currently below this daily demand zone. If this daily demand zone fails and we do not get a recovery back above that 75.05 and ultimately above the 75.80 or 75.82, then I'm expecting to see the S&P 500 fall down to these areas. Now, there are a few minor areas in here. You can go into our posts and see the details of those. I think one of those, there's a fair value gap right in this range, right around 7,200 or so, 7,180. That could be a potential catch for this, but there's not much to stop the S&P from falling down to this way, folks. So come in, take a look at that. This is the one from July 15th. You can see some of the details there and where we're already targeting. If this area doesn't hold, we get a daily close below this, expect it to fall here and then here. Then we did another post a little bit later, just an update on July 22nd, say, hey, they're still smiling and folks are still buying. People are still saying it's buying, but in our minds, the bearish confirmation is there. If we got another close below 75.05, that was as of 6 days ago, and I'm gonna play it forward, and we did. So we got another close below. All indications is that the S&P is coming down to this area, folks. So that is a call for shorts and puts. All right. So that's our pretty much it for our market review for today. I thank all of you, or the few of you, whoever may have joined us on here, or if you're catching this video a little bit later, please leave us some comments. Leave us some questions that you have in there. If there's something that wasn't clear and you didn't quite understand how we did something, drop us a line there. Also encourage you to check out our Trading Academy page at tradingacademy.akeelah.io. You can see on here just a lot of basic information about what we do here and the different areas or opportunities that we have for you to learn. You can always come here, join our weekly classes. We typically, I'm starting to do these market reviews on Tuesdays at 7 p.m. Eastern time. I had some other things that's going on today that I needed to make this a 4 p.m. class. So that's why it's at 4 today. We apologize to you if you were waiting to catch it at 7. But please watch the replays of these. Leave us some comments, hit that subscribe button, and we look forward to seeing you again next time here with Akeelah Traders. Thank you.